Welcome to the REI Diamonds Show with Dan Breslin, your source for real estate investment jewels of wisdom.
Welcome to the REI Diamond Show. I'm your host, Dan Breslin, and this is episode 187 on investing in multifamily properties, 150 to 300 unit deals with Chris Larsen. If you're into building wealth through real estate investing, you are in the right place. My goal is to identify high caliber real estate investors and other industry service providers, invite them on the show, and then draw out the jewels of wisdom, those tactics, mindsets, and methods used to create millions of dollars and more in the business of real estate. Chris Larsen is the founder and managing partner of Next Level Income. He's been syndicating multifamily property deals since 2016 and raised more than $15 million, over $150 million in acquisitions. Chris's company is focused on identifying high-yield passive investments ranging from real estate to oil and gas leases. On this episode, we dive into his asset selection process, favorite multifamily markets, and some risk mitigation strategies that served Chris well during the recent pandemic, as well as some other topics. Let's get right to it. All right, Chris Larsen, welcome to the REI Diamond Show. How you doing today?
Dan, I'm great. I'm excited to be here with you. Thank you.
Nice. Yeah, it's always looking forward to these high-volume, multi-millions of dollars raised and, conversations I get to have with guests like you. But, for anyone who doesn't know your name already, maybe doesn't know about your podcast, do you kind of want to talk about maybe the evolution of your career, starting with, let's say, your first deal and then ending with your current business model, Chris?
That sounds great. Yeah, Dan. So I love real estate. I set off to be an investor when I was really a teenager. Kind of long story short, I raced bicycles. I started racing when I was 14, and I'll never forget that feeling of freedom I had when I first left my neighborhood on my bicycle. And it really instilled in me this ability to kind of go where I wanted to and do what I wanted. And when I was younger, that meant racing my bike. And when I got my driver's license, I was excited to get my driver's license so I could drive to races outside of the state. And so I was traveling when I was 16 years old, up and down the East Coast, across the country in planes, raced even at a national level until I was in college. And at that point, I wanted to be a professional cyclist. I went to Virginia Tech. I was doing an engineering degree. I knew I didn't want to be an engineer, but I also didn't want to be poor. And if anyone knows anything about cycling, they know that bike racers are pretty poor, unless you're racing in Europe, which is a very, very small portion. You just don't make a lot of money, like a lot of professional sports. So I was entrepreneurial. I would do different things in college, but I quit cycling after my best friend, my training partner, my roommate passed away. He had a massive brain hemorrhage. And I spent another year kind of pouring my heart and soul into the sport, but I realized I wasn't happy. I still wanted that sense of freedom. And I thought, well, I'm not going to race my bike anymore. I'm not going to be an engineer. Like, what am I going to do? I started day trading in the stock market in the late 90s, which there are a lot of similarities today, Dan, in my opinion, between the market then and the market now. So it's very exciting. It was also very stressful. So here you take a junior, 20-year-old in college making $5,000 a month day trading, but couldn't sleep at night. And one morning at 3 a.m., I just remember thinking, what the hell am I doing? And I kept reading books. I've always been an avid reader, and I started learning about real estate. I bought my first property at 21, and what I learned was the leverage, the control, and the tax benefits were something that really fit my personality and my interest. So I built a portfolio, and it was all single-family rentals at the time, so probably like a lot of people listening, and I thought that was the way to go. And after about 15 years of doing that, dealing with tenants and toilets and different headaches while also being a professional, I was a medical device sales rep doing well in that space. And I was on call. And I was getting phone calls from my tenants. I thought, man, I don't want to do this anymore. I ended up transferring all my equity from those deals into commercial deals. Really, multifamily was the main focus. And what we do today at Next Level Income, Dan, is we help provide education to people that are looking to take their income, their investments to the next level, whether it's in real estate or otherwise. And also we syndicate opportunities. So what that means, if you're not familiar with that term, is we allow investors to come in alongside of us, and they can invest in larger commercial deals. And this is mostly for people that want to be passive investors. So if you like to swing hammer, get some, higher returns by being an active investor, that's not our specialty. We specialize in helping professionals like doctors, business owners, other professionals that want to get involved in real estate, but maybe they don't have the time or the knowledge themselves.
Nice. A lot of good stuff there. I'm sorry to hear about your roommate passing. It sounds like that was like maybe a little bit of a catalyst for you or the wake-up call.
Yeah, I mean, it's, as I've learned about things over time, Dan, I think when we're young, almost everyone feels like we're invincible, right? And I was reading a few years back about children that lose a parent and how that is correlated with success. I was thinking, like, that's a weird thing to be correlated with success. You'd think if you lose a parent, that would be a hamper, to your success. That would be a hindrance. But what I realized is that when you lose somebody like that at a young age, you realize that time is finite. And immediately I knew that my days were numbered. My time was finite. And I knew that racing a bike wasn't the best use of my time. So it certainly was a wake-up call. I realized, man, like, I don't have a girlfriend. I don't go to parties. I don't have that much fun. Yeah, I'm doing really well as a cyclist, but I'll never forget winning a race and feeling hollow. Thought, why the heck am I doing this if I'm not getting any enjoyment out of it? So it was certainly a wake-up call, and it made me realize that I had to make the most out of every day. And that didn't mean going and blowing my money and having all the experiences. It meant making the most in terms of, what I could do as a professional, what I could do in the investment space, but also enjoying every day as if it was my last.
Yeah, it's good stuff. And I feel like there's this, I don't know, I mean, you got the catalyst or the wake-up call or this, like, sense of purpose. And, like, I know that when I used to hear that kind of stuff before, leadership books from whoever, CEO that wrote it for their speaking career, whatever, right? I used to give it like, that's nonsense, just give me the money, I want to make the deals. But I remember my daughter, I moved to Chicago from Philadelphia in 2014, 2015, right around when the year changed. And the reason that my daughter was living in Chicago before that and I was living in Philadelphia where I grew up is that her mother and I kind of went separate ways as I skidded on the rocks from a drug and alcohol problem way back in, 10 years before that. So, but I got clean in 2012 for good, January 21st, God willing. And
congratulations.
Thank you. And it was not exactly this big catalyst and life-changing moment, right? There was no fanfare. There wasn't a DUI. There was no skidding against the rocks when I got clean. It was just like it sort of fell off and the time was then. But where I'm going with this is, a year, 2 years, 3 years later, I started to build up some kind of, level of momentum success in my real estate business again in the Philadelphia market. And back of my mind, it was like time is finite, and I wanted to move to Chicago so I could be near my daughter. It was kind of this dream I always had. And there was never really a right time to do it. It was weird. There wasn't like a shocking moment, kind of like you described, where I was, oh my gosh, now's kind of the time. And then, it happened that I, set the date and I did it. And I think for a lot of people, we're doing these certain things, whether it's like thinking about getting into real estate, thinking about making an investment in some real estate, buying that first piece of property, maybe a career change. It's like, I don't know. Sometimes you just have to set the date and like find this way to spontaneously make it happen. And like on the other side of that, Chris, as we were talking before the recorder, moving to Chicago for my daughter ended up placing me in another market. I learned how to do real estate in Chicago's market and then added on Atlanta's market. And, things have really gone in a whole new great direction for me personally as a result of that. So it's, I don't know what the takeaway is. Maybe there's trying to get yourself this like sense of purpose to act now, or literally looking at some kind of big life events that occur and then using that as a catalyst, something to kind of leverage yourself forward.
Yeah, I would say, everything begins in your mind. Like mindset is key. And, if you're sitting there and you're trying to determine, so it's, as we record this, we're coming up on March, and I spent 18 years, as I was mentioning, in the medical device profession. And actually March 31st is my final day. I'll be transitioning out. It's been something that I've really had an identity with in my career. And it was something that allowed me to make money that was the capital for me to invest. And I've really struggled over the past few years because I haven't had to work in this career for probably 4 years, with everything that we have going on in the real estate world, but I've enjoyed it and I struggled to let go of it, and really more so in the past 2 years. And I was coming back from Utah with my son, and we were coming back from this impromptu ski trip to go visit a good friend that moved out there. And he looked at me and he said, "Dad, I love you. Man, I had such a good time. I want to do more of this." He's 10 years old, Dan. And I thought, you know what? I can do more of this, but I've been able to do more of it. I just have chosen not to. And look, 2 days later, I said, you know what? I'm going to tell my VP that it's time to move out of here. So I made that decision. And if you're sitting here listening, thinking, oh, I could do this, or I want to do this, I just haven't done it. The day I made that decision, the doors that opened were incredible. It's just been amazing. So it all starts in the mind, but like, I think his name is pronounced Coelho, says in The Alchemist, once you decide on something and you commit to it, the universe will conspire to help you. And I truly believe that, but it all has to begin in your mind.
Yeah, you're right about that. A lot of good stuff there. So let's shift gears a bit. I was doing some research before our time here today, and I noticed that you had some history in oil and gas leases. Is that correct? Maybe you could talk about that. It's kind of a unique topic for us real estate folks.
Yeah. So, it's as I've learned over the past 2 decades as an investor, I see that there's similarities in other asset classes with real estate. So let me give you 2 examples. I'll end on oil and gas, but life insurance is a big one. My father also passed away, another life event when I was 5, and he had a couple small policies. He accidentally left one open, didn't cancel it, which helped my sister and I go to college with a very modest sum. But my mother passed away in 2011, and my stepfather said, sorry, she didn't have any life insurance because it was too expensive. And I will tell you, no one ever says, oh, I had too much insurance when they use it. Never, you never say that. You might not want to pay for it, but you always want enough insurance when you have it. I'm a big proponent of whole life insurance because whole life is a lot like owning real estate in that you have a level premium. It may be set for 10 years, 30 years, kind of like a mortgage. But what happens is you get equity that builds in it, and you can leverage that equity and put it into other assets while it's providing value for you. So just like a house that you can live in, then you can pull money out of that house to invest in an investment, for instance. Oil and gas, it's another real estate play. So it depends on how you look at it. But the group that I work with, they're real estate guys, and what they do is they go in and they find oil or oil fields, assets that are already producing, that they can optimize, that they can increase the value, and then they turn them typically on a 3 to 5 year period, very similar to a value add real estate play like we do. Now, one of the things I love about real estate are the tax benefits. So Dan, there are very few things out there that have better tax benefits than real estate, but oil and gas is one of them. And with the 2017 Tax Cuts and Jobs Recovery Act, the bonus depreciation that came from that, the tax benefits for high income earners is really, really good for oil and gas. So if you're a high income earner and you're looking for investments, that are either alternatives to real estate or just to compare, it's certainly worth looking into, in my opinion.
Is that something that is part of what you provide as the next level income education to passive investors? Is this still a product that's viable that you discuss with people even today?
Absolutely. So the group that I initially invested with, I can provide access to anybody that's interested if they want an introduction to that group. There's obviously other groups that are out there that they can do, but I like the group that I work with because they're real estate guys that understand kind of the strategy that we employ at Next Level Income. And, that's something that, people that I coach, we always look at their individual opportunities. So, if you're listening, I'm not your personal advisor. If it's something you're interested in looking at, you should always consult with your accountant, your personal advisor, to see how it applies specifically to you. But the last thing I'll say is I think we're in a very interesting time because if we go back 12, 18 months and we look at oil and gas prices today, they're significantly lower. And I think it's one of those times that, I don't know if you call it once in a lifetime, but definitely once in a, 10, 20 year period opportunity for oil and gas, in my opinion.
So in a sense, it's a great buy-in moment because of the market. The oil and gas market is so low compared to how it normally looks or what it might look like after a 3 or 5 year recovery from COVID's shutdown market.
Yeah, so there's a couple things playing into that. So one, with COVID, with demand pulling back, prices have pulled back as well. But if you go back and you look, whether you're Republican, Democrat, Independent, whatever, if you go back and you look at the administrations that have been pro-energy, typically you see lower prices. If you see administrations like the previous Obama administration, now Biden, he's shutting down some of the opportunities to explore for oil and gas. And it doesn't take a genius to figure out that if you increase demand coming out of this COVID crisis and you decrease supply at the same time, what's going to happen to prices? Most likely, in my opinion, they're going to go up.
Yeah, I think you're right about that. And I think there's probably also some negative sentiment with the height that Tesla stock has gone to in the past, 6 to 9 months. So the investor sentiment against oil in favor of the electric car and energy is what it is. But I think we're still we got to be like a decade, 15 years, maybe even 20 years out from a point in time when the demand for oil is not going to have the kind of effect that it's going to have 2 years from now.
Yeah, well, listen, if you look at what just happened in Texas, with the bad weather that happened, with the wind turbines that shut down, I love renewables. I've had a Prius. Actually, my wife and I own a plug-in hybrid right now. We've had solar panels on our roofs. I got my church to start recycling when they were 11 years old. I'm an environmentalist. I love the environment. But the fact of the matter is we can't run the economy today without oil and gas. And it's going to be a while before we do that. So I'm all in favor of renewables and alternative energy sources out there, but this isn't something that's going to go away next year. Now, 10 years from now, we might be having a different discussion, Dan, but I think the window of opportunity is open right now.
Yeah, I don't know because I wasn't paying attention to the stock market and the economy in general 10 years ago. But I wonder, as Elon Musk was forming whatever his solar company is 10 years ago, and I remember, 2006, 7, 8, right around that time, I remember the articles in Forbes about green energy and we're doing green building and everything, and there was kind of the same fanfare 10 years ago, and I feel like a comment like that could happen 10 years ago. Yeah, I don't know, maybe we'll have this conversation in 10 years, but I don't know, maybe there's still quite a long runway to go for oil.
Yeah, you look at, I think there might be. And you look at China, they're building clean coal facilities over there that scrub 90% of the stuff coming out of the plants. They're also building next generation nuclear facilities over there. And if you're listening, you disagree with me, that's fine. But, the facts are the facts. Like, there are energy sources out there. We need more than just renewables today. And again, when it comes to making money, I'm fairly agnostic. I will look at things, and if it doesn't make sense for my social, sphere when it comes, or my social filter when it comes to that, I may pass on it. But, if you're an investor and you're looking at opportunities out there, I certainly think that should be something in your scope that you're looking at.
So you also touched on life insurance, and I've had the conversation, I think, with people on the show, and certainly with brokers and agents for the whole life insurance policy about the banking on yourself product, right? But I'm curious, and for me, it felt probably more along the lines of me being young and invincible, and then I'm not going to die anytime soon. So I bought the 20-year term policy instead of the whole life, just to be, safe for at least the near term. But the whole life insurance policy is a good investment, right? When I was researching for this episode, Chris, I had the revelation. It was like, okay, so, if I were 10, 15, 20 years more in age, whatever the case is, I don't know if maybe it's better to think about the whole life insurance policy as sort of a bucket of cash that I'm trying to put away now for my family and for my heirs later as probably the highest concern for why I would make that investment in life insurance, because you get this tax-free ability to move that cash to the heirs. Is that correct?
Yeah. So you've done some research, Dan, And the one thing I would push back on is when people say, hey, like life insurance as an investment, I say, don't think of it like an investment. So let's kind of stop there for a second and say, okay, life insurance is something of value, right? If you want to have life insurance in place, if you have children, if you have assets, if you want to set up a legacy, there's value in it for that. Whole life insurance can be a tool that can be utilized for multiple things. So we actually started our policies, my wife and I, when she was pregnant with our first son. He'll be 11 here. And we said, hey, let's set this up instead of a 529 plan, because there's some disadvantages to having a 529 plan. You know, so if you have a 529 plan, it may affect your children's ability to get scholarship and aid. You can only use it for education. So I thought, well, hey, what if we start, this life insurance policy? We have access to the cash while we're saving it. If something happens to, me or my wife, because we both have policies, then they can provide that benefit for our children, right? So we wanted that. And then as I started to learn more about this, Dan, because we started these in 2010, 2009, we started them. My son was born in 2010. What I realized was, wow, this is a really good way to put cash in between deals that I'm going to invest in real estate. So I ask my listeners all the time, what are you doing with your cash between deals? We're earning 4-5% within our insurance policies now that they're set up with that cash that we're putting in there. And it's a great opportunity to put money in there and then pull it out when we need it. So it's a tool to utilize. And then if you're an entrepreneur, you don't have a 401k, you don't have somebody that's matching your plan. If you're a real estate investor, a lot of people say, hey, I'm going to start a self-directed IRA. Well, you could put money into a life insurance plan, a high cash value life insurance plan, and you could set it up as a retirement plan for yourself, kind of like a Roth IRA, because you can take that money out tax-free when you need it at the end of your working years, if you want to do that, or part of your financial independence plan. But you can move it in and out in the meantime and get access to that cash. So again, I would say, think of it like a tool. And if some of the things I've said are appealing to you, if you're like, oh, I could use it like that, then go ahead and explore it as an opportunity. We have a whole section on our website under the banking link that people can get a white paper, they can watch a couple videos and see how we do it. And we actually work with specialists that focus on working with investors so they know how to structure these policies for investors.
Let's say I had $1 million in cash and I were, 65, 70, whatever. I was up in my years or maybe not. And the only thing I was trying to do with that $1 million was pass it on to my heirs without any kind of, taxes having to be due on that. I mean, is that possible to kind of sink a large chunk of cash into the whole life? And then if you did pass now, I mean, I don't know, maybe someone couldn't get the underwriting if they were terminally ill, but if they already had the plan and were terminally ill, sitting with that $1 million in cash, trying to give it to the heirs without any kind of a tax consequence, or I've never had to do estates and that kind of thing, so it's sort of like I'm out on a limb with the idea. Does that make sense, Chris?
It does. Yeah, so there are other vehicles out there. So if you got $1 million cash sitting around and you're trying to figure out the best way to pass it on, I would talk to a good estate planning attorney first and foremost. But I think the one thing with insurance is the younger you buy it, the cheaper the insurance portion is. So as you get older, you have to consider the fact that the insurance cost is going to cost more. And because life insurance has such great tax benefits, actually in the 80s, there were some laws passed by Congress to decrease those tax benefits so it wasn't just a tax shelter. But you can certainly dump a bunch of cash in there. And if you want to pass $1 million on to your heirs, you probably don't have to take that $1 million in cash. You could buy $1 million and you could do other stuff with it when it comes to the, your investments with that. But again, I think it's certainly something that should be investigated.
Makes sense. So my favorite topic, and it sounds like what you kind of did as well, you talked about the single families that you had, single family houses years ago, and then you talked about getting all that equity and putting that into commercial. I assume that's probably multifamily. That's kind of what I'm in the process of doing personally. I like multifamily. It makes sense to me. It makes sense to all our listeners on the show who are doing residential single family fix and flips, real estate agents. everyone kind of understands because you live in a house or an apartment at some point. So we sort of understand that as an asset class, as a first stepping stone, most of us, to getting into the larger commercial deals. Do you want to talk about that transition a little bit, Chris, and sort of what that commercial segment or portion of your investment activity is looking like over the last 6 to 12 months?
Yeah, so I started out in the single family space. And again, if you're somebody like me that had like $3,000 in the bank and you wanted to, go out and buy a property, it was basically the only option that was out there. So I'm a big proponent of doing like a fix and flip, or going in and buying a house that you can fix up, live in for a couple of years and sell tax free if you're looking to do your first deal, or Airbnbs. But what I realized after 15 years, Dan, of having these properties, as the equity grew, my return on the equity I had in these deals was like 7%. And then I had to pay tax on those. And that was, I'll tell you what, getting 4 or 5% after tax isn't a great investment in my opinion. So I looked at multifamily, and at the time I could get a better cash yield, and I could get the appreciation on top of it, and I didn't have to manage the properties. So that's why it became so interesting to me. When I looked at the demographics, I'm a demographics guy. I got into the medical device industry because of demographics. I moved to the Southeast because of demographics. We still invest and buy in the Southeast because of demographics, and we buy multifamily because of the demographic trends. I think it's going to be stable for the next 5 or 10 years. I think it's a very good place to invest still to this day. When it comes to what our group does, we're going out and we're looking for high quality, institutional quality assets in the B plus, A minus space. So, what that means is we're looking for properties built in the last 20 years. And these are in neighborhoods and cities that are growing faster than the national average. Places like Raleigh, like Charlotte, like Atlanta, just like you, Dan, Jacksonville, Florida, areas that are growing, that people are moving to from other areas of the country. And we're going in, we're improving those properties, improving operations, driving the net operating income higher, driving the value of the properties higher, and ultimately allowing good returns for both our investors as well as us as we invest in all of our deals.
Are you thinking long term, the exit strategy on these is like a 3 to 5 year refinance and cash out your investors and keep it for a long, undetermined period of time? Or are you looking to exit those deals at that 3, 4, 5, 7 year sweet spot and kind of capture the windfall of that forced appreciation?
Yeah, so it's more the latter. So we try to align ourselves perfectly with investors, or as well as we can with investors, I should say. So we're looking at a 3 to 7 year hold period, typically get in there, execute our strategy. And if we're able to turn that property within that window, we're going to look for a property that we can then leverage our equity into the next property at that point.
Gotcha. Did you sell out of the single families? Was that something you kind of literally let go of completely, or do you still own some of the? Okay. All right.
Sold all of them. Yeah. Sold all of them. So we have our own personal, single family residence right now. We actually have an Airbnb, and another, actually have 2 short-term rentals, but yeah, we don't have any single family properties that we currently manage ourselves.
Not a bad place to be. So how many deals are you in the middle of, or what kind of a deal size multifamily are these typically that you're looking at? Are these, sub 100 units, 100 to 300 units? What would be the size sweet spot?
Yeah, so the properties we're targeting typically 150 to 300 units, and those are going to fall in the markets that we're looking at, $20 to $50 million range. We bought 3 separate properties last year, and those it's over 125 million roundabout total.
That was in 2020 through the pandemic. You closed on 3.
That was in 2020, so it was a bit of a rough year. So we put a property under contract early in the year in Q1. I tell people I feel like I did the capital raise for that property 2 times because it was a lot of people got nervous and pulled out. But we closed on that deal on time in May, and then nothing happened, as you're probably aware of, Dan, for like 6 months. And then we closed 2 properties in Q4 that are doing quite well. Actually, the property we closed on in May it may be the best performing property in our portfolio. So I think it's a testament to the stability of multifamily, and our resident base is typically a little bit on the higher income side, so 60,000 plus a year, and our collections have been around 98%. So they've been nice, stable assets. Again, if you hear me talking to an investor, I say we kind of have the Warren Buffett strategy of real estate, and like Warren Buffett, it's not real sexy.
Gotcha. So what are the cap rates on a B plus, A minus 150 unit? I mean, it is trading at, like, when you bought it, like a 6.5 cap, 7 cap, and like, what's the upside of them on the resale? I guess we don't know the upside, but what would be the cap rates expected that you would actually get excited and close on a deal in May of 2020?
Yeah, so it depends. Like, if you looked at some of the stuff we were buying, like workforce housing, cap rates were in the sixes, and we're seeing cap rates, even down below 5 right now. And you have to look at your strategy. So depending on what you do, cap rates cut both ways. For $1 that you increase in operating income at a 5 cap, that's a 20x return on your money, right? So you have a 10 cap and you increase at $1, that's a $10 increase in your money. And so what I mean is, if you're buying a property at a 10% rate of return, you increase it $1, that's going to be a $10 increase. So it cuts both ways. You don't have to move the numbers as much on these properties with lower cap rates, but you also have to be cognizant and say, hey, do we think cap rates are going to be stable? Are they going to go lower? Or are they going to go higher? And that's a long discussion. I actually had Glenn Miller on the podcast early in the year. Actually, I think it was technically the end of last year, to talk about that and why he believes that cap rates are going to stay low, because the Fed is going to hold interest rates low for the foreseeable future.
Yeah, and that comment comes on the heels of the Fed making that announcement to save the stock market yesterday when the rates were expected to rise and everybody got panicked. But I digress on that one. So, the lower the cap rate, typically, Chris, is that going to be newer product? So when you're saying 20 years, we've had a lot of people prefer that 20-year age or younger product. Are you expecting, should I expect as an investor, maybe a higher cap rate if it's older than that? Obviously, it's a higher cap rate because my risk is higher. If I'm getting into a B or a C property, a little harder to get collections and things of that nature. Correct? Yes.
So there's typically a few different variables that are going to determine your cap rate. So the more core, quote unquote, core of the market is. So if you have like LA, New York, even like Denver and Austin these days, you're seeing cap rates. I mean, also like California, in Orange County, I've seen cap rates like in the ones out there. So you're talking about just really, really low cap rates in those markets. Yeah. When you move into like secondary, and that also, I'm sorry, let me stop for a second. That would also apply to like new construction, in these markets. It's typically going to be a lower cap rate because there's less maintenance. You're going to have a higher quality resident. There's more stability. When you move into secondary markets, so that would be what I would call like a Raleigh, for instance, slightly smaller markets, you're going to see cap rates move up. When you move into older product, 10, 20 years old, you're typically going to see cap rates move up again into those markets. So typically cap rates are going to be inversely correlated with the risk associated with that. So, depending on how you turn those dials, you can see cap rates go, like I said, down in the ones, versus, some multifamily. I was talking to an operator earlier this week, and they say in the markets that they're seeing, in the 8s, which is, there's some other different variables that apply to that. But what we're seeing is typically 5 plus or minus in that B plus A asset secondary markets today.
How much monthly cash flow is there going to be? I mean, I was doing the math on something I was looking at, small building, 20, 30 units, something like that. One was at like a 6.5 cap. The other one was like at an 8. And I was just penciling deals on a napkin. It wasn't even like a real deal that I was looking at that was advertised, or maybe some of it was. I was shocked at how small the cash flow was, the cash on cash returns, probably like the single family example that you talked about, where it's 7% cash on cash, and then you pay taxes and you're down to 4%. And it's like, geez, what's the point? And maybe the reason that, the strategy with multifamily is to right the ship, manage the property right, and then sell it 3 to 5 or 7 years out, because that kind of makes it all worthwhile. I mean, what kind of monthly cash flow comes in? You get 100 units at $2,000 a month. It's $300,000, and then all the expenses go out, and there's like 10, 20,000 left at the end of the day for distributions, or is it small? Is it I'm always curious what those numbers actually look like on a deal.
Yeah, I'm always careful to talk about returns, Dan, when it comes to that, because it's always different on a deal-by-deal basis. But what I will say is the cap rates don't always correlate one-to-one with the cash flow, because you have to consider the type of debt that you're putting on it. So, in today's market, if you have a 5 cap property, but you're able to finance it sub 3%, which we've done, then, that's going to positively affect the cash flow. Also, it depends on your leverage. So, if your leverage is 70%, that's going to be different, and it's going to have a different structure than if your leverage is 70 or 80%. So it depends. But what I can tell you is that for our investors, typically the cash flow, especially on an after-tax basis, is compelling. It's certainly way higher than you can get in, a stable government bond, typically many, many multiples above that. And there's appreciation that comes on the backside of that if the strategy is effectively executed. And then when you wrap it with the tax benefits, and I go through this all in my book, and if you're listening and you want to learn more about our strategy, I'll actually give you a free copy of our book. Just go to the website and click on the book link, and you can see how to get it there. But all these things are going to depend. And, considering it's a passive investment, I think you can expect, returns definitely above 10% if you go all in. I've seen returns well above that in our portfolio over the last several years, but it all depends on a deal by deal basis and the market to market.
Yeah. And I didn't mean to be prying. I guess I'm curious because it's like,
oh, not at all.
Yeah, I don't raise the money. I don't feel like I mean, we borrow money for 6 to 9 months when we're flipping a house. And sometimes we screw up big and we're in a property for a year and a half sometimes, but you're going to have that with hundreds of deals each year where once in a while we do a bad deal. And so I guess my context,
Sure.
Personally, my paradigm is colored by some of the failure and not so great deals I've done in single family. And I'm thinking to myself, if multifamily and these larger syndications operate anywhere like this, and I'm stuck in this 150 unit building that somehow turns, way negative upside down, I don't know that I'd be able to sleep at night for the 3 to 5 or to 7 year period of hold. And it's probably a mindset problem for me. And not that I should stop what I'm doing because it's working and shift to multifamily, but it's definitely been fears that I've had along the way. Were there any fears of this nature or hurdles that you mentally had to overcome as you made the shift from single family into, let's say, the first scaled up multifamily, Chris?
Certainly. And, look, it's like anything, if you're driving a single car down the train track, and the train derails, it's going to be a lot less of a issue if there's 200 cars than if there's 200 cars on the track, right? So you think about the size of these deals and if it goes sideways. But what I will say is there's a lot more control involved in the multifamily space from a single family space. You can control the income and it can be more stable. You also are diversified, right? So, if you have one house and your tenant moves out, that's 100% vacancy. If you have a 200 unit apartment building, one tenant moves out, that's less than 1%, it's 0.5%. So some of the things that we do, Dan, to mitigate the risks involved is, one, we buy cash flow positive properties. Our break even, we're typically seeing break evens below 70%. So what I mean is, our properties would have to go below 70% occupancy. And most of our properties are in the mid 90s in occupancy. That number may dip if we're turning a lot of units for rehabs, for instance. But, if you have a property that's stabilized in the, 93, 95% range, it's got a long way to drop to get below 70%. So typically for our investors, there's a large margin of error or a large margin of safety when it comes to those things. And then you look at the debt. We're not putting typically short-term debt on these properties. So we're using agency debt. And what that means is, Fannie Mae, Freddie Mac, 10-year debt. And it's low, it's stable debt. And if we're trying to execute on a 3 to 5 year timeline, that gives us some back end room where we know, we're going to have a 3-4% interest rate for that period of time. So we know what we're going to be able to do. And then we also keep ample reserves. So we want to make sure, that we can operate a property, with no income for say 6 months. So if we have 6 months of cash reserves in the bank and we have, stable debt in place, and we know that our break even has to drop really low before we start burning through cash, we can always stop doing renovations and still make money, or at least break even, and have some cushion with respect to that. And what I can tell you is last year was a good stress test with this, and all our properties continued to make money throughout the pandemic. So, we feel like we were tested pretty well last year, and our strategy, our properties continue to perform. And maybe there's a little luck involved with that. But, we continue to refine and make sure that we have these measures in place to mitigate those risks.
Yeah, and I would guess too that those lower cap rate, higher ranking in the A- tier property with higher incomes, that was exactly the kind of risk that those higher cap rates reflect when something like COVID occurs. So, the lower down the scale you go on that, average yearly income, let's say, of the tenant population in a building, the higher the chance that you kind of have someone who's digging their heels and saying, you know what, evict me, good luck. I'm just going to sit here on the couch and and call for COVID relief. I know that on my property, I do have some, kind of C high rate of return properties that I like for that reason, that they cash flow heavy. But I was lucky like you, and that I really didn't have many, or if any, tenants at all do that. Although in some of the properties we're buying, we're dealing with tenants who have dug their heels in and are claiming COVID, and we've got squatters and properties we were trying to flip. So we did get dinged up on some of the properties, but we were lucky, kind of like you, on most of them. I was surprised to see that, looking back a year ago or 9 months when COVID shut everything down. I didn't think it was going to turn out this way.
Yeah, it certainly was an uncertain, scary time. And I don't think we're fully out of it, but I think, when it comes to housing, multifamily, workforce housing, single family housing, we're still not keeping up with the demand. Again, that's another thing I talk about in my book. We need about 330,000 units a year, and we're just not building enough units. And even the units we're building, Dan, these are newer units because the numbers don't make sense to build affordable housing. I like to say you can't build affordable housing. You can subsidize it, but you can't build it. You just have to get more units out there and create more supply for people, in my opinion.
Yeah, it's the same thing that I have said on the show, and the economists have said coming on the show, that we simply don't have enough houses, and that's like really why we're in this jam that we're in. As far as inventory goes right now, we have artificially low supply because people are afraid to list their house on the market due to COVID, and we also have artificially low supply because investors who would go to the courthouse steps and buy foreclosures and sheriff sales in most cities, that's not an option right now with the different stays that are in place. And so there's no inventory to come on from neither of those two channels. And, we're in this like kind of superheated real estate market. I think it will normalize in the next 6 to 9 months and probably stabilize. I don't think it'll stay as hot with, 16% year over year increases I think we saw in Atlanta for the medium home price. I think it will stabilize and be flat. But I think that this longer systemic problem that was already here before COVID hit of not building enough houses, probably a hangover from the 2004 to 2006, the period of overbuilding, but also probably a sign of there's not exactly large tracts of buildable land that are close to the city cores that's even available. So it's kind of this one-off having to do this infill construction, which you just mentioned, Chris. It's more of the tear down a house that you bought for 100, 150, 200,000 and sell a property for 850 to $1 million. Like, that's not affordable housing. There's nowhere really left to even build it,
Yeah, it's really creating this perfect storm in that space, in my opinion. And, what I was saying, if you go back and listen to some things I was saying 6, 9 months ago, 12 months ago, I think that, the challenges that we faced last year, while not great for the multifamily market, I'm not going to say like 2020 was our best year from a portfolio perspective. It certainly was not, but we still made money. We didn't make the most money we've ever made. But that demand has to go somewhere, and it's going to roll forward. And because there's going to be less supply, the demand is going to be pent up. People aren't going to be able to buy homes because they had to burn through savings. You know, millennials are jaded. They're like, maybe I shouldn't buy a house. What if I have to move? What if I lost my job? You know, a lot of these questions are in the back of their mind. All those things are good for the multifamily space. I don't love it for those individuals or for the country necessarily, but from an investment perspective, this is going to be good for the housing market in terms of, you know, if you're a landlord, if you have multifamily properties.
That makes sense. So, Chris, as we do our wrap-up section here, are there any books, maybe you do another plug for your book or another book or two that you maybe recommend to people in the real estate space most often?
Yeah, so obviously Next Level Income, get a copy of my book. You can, like I said, you can get it for free on our website. There's so many books on the real estate space. It all kind of depends on what you are looking for. So I'm more of a mindset guy. So, you know, I love like Napoleon Hill's Think and Grow Rich. You know, Rich Dad Poor Dad, a lot of people talk about with respect to, you know, getting them into this mindset of being a business owner and doing that. So I kind of go from this high level mindset space down to, okay, you know, what makes sense with respect to, you know, what you're doing from a real estate perspective. But I will recommend a book for you, and that is The Perfect Week Formula by Craig Ballantyne. And I don't care if you're in real estate or an entrepreneur or anything you do. If you read that book and it helps optimize your time, you're going to get better and be more productive. So I think who doesn't want to be better or more productive in whatever area of your life? And I think the number one thing I hear from the people I coach, Dan, isn't, hey, how can, you know, I want to buy another deal, I want to make more money. They actually say, hey, I want more of this so I can spend more time with my family, so I can work out, have better health, better fitness. And Craig teaches some things in that book that are going to help you do just that. So if you want a copy of it, send me an email, chris@nextlevelincome.com. I'll send you a link. You can also get a free copy of Craig's book. So you get a two-for. You get our book and you get Craig's book if you email me.
Nice. So the final question I ask everybody, some variation of this question, the crown jewel of wisdom. It's the REI Diamond Show, so the crown jewel. If you had to go back, let's say, I don't know if 21 when you're buying that first property, or maybe a handful of years later as you were getting ramped up with the single family, but what would you go back and tell yourself knowing what you know now, Chris, if you could go back 10, 12, 15 years to maybe help shortcut some of what you had to go through?
Buy a multifamily deal, learn how to operate it really well, and that's why we founded Next Level Income, is to help teach people some of the lessons that I've learned over time. And I don't want other people to have to spend that same 10, 15 plus years learning that I had to do.
Nice. Do you want to repeat the email address and also point listeners to a website where they can get more Chris Larsen or Next Level Income?
Yeah, absolutely. nextlevelincome.com. You can find all our resources there. Click on the book link. You can get our free book. You can contact me on that page. You can also check out more information on, we talk about bank on yourself, infinite banking. Just go to the banking page. Tons of free resources there. And if you're interested in coaching, you can email me also at coach@nextlevelincome.com.
All right, cool. Hey, I had a blast. I got pages of notes here. I appreciate you for coming on the show, Chris.
Dan, it's been my pleasure. Thank you so much for what you do for your listeners, and I'm a pleasure to be a part of it.
My favorite way to fund a fix and flip deal is by using private money. I did an episode on raising private money for single family flips a little while back, detailing my entire process with Joe Fairless, as a matter of fact, which you can find at reidiamonds.com by typing raising private money into the search bar. But what if you don't have access to private lenders and need money to get started? Everyone usually talks about hard money, and that's great as long as you have some reserves or a nice chunk of cash in the bank to show the hard money lender in order to get the loan. They like to loan money to people who already have a little bit of money, at least, to be able to cover the payments and any other ancillary construction items that may come up. But one little known and little talked about option is gap funding. And gap funding is a line of credit used to access the funds needed for reserves, business startup costs. I mean, there's really no restriction on how you use the funds. And it's called gap funding because it's used to fill in the gap. The team over at REI Pathway Funding can set you up with gap funding line of credit, which has an initial interest rate of 0%. And in certain cases, if you qualify, it does not show up on your credit report as it's structured as business loans. So to find out how much you might be pre-approved for, go to www.reipathwayfunding.com. Thank you for tuning in to the REI Diamond Show. Remember to review and subscribe on your podcasting app. Just search REI Diamonds and click subscribe. Interested in receiving my weekly Big Idea email, where I provide the most valuable jewel of wisdom I discovered during the recording of the most recent episode? Sign up at reidiamonds.com. At that site, you can also access the 187 episode archive. Again, that's reidiamonds.com. So far this year, my house flipping company, Diamond Equity Investments, has bought and sold 56 houses. Well, mostly houses. A few were apartment buildings. And we currently have 133 more in our inventory, either under construction or under contract and awaiting closing. Here are 3 ways we can do business. Number 1, are you interested in having access to the best real estate deals in your market? In other words, access to deals you can buy at low enough prices to actually profit after renovating and reselling? If so, go now to accessrealestatedeals.com. Number 2, accredited investors seeking double-digit returns can sign up for my private mortgage investment opportunity emails at fundrehabdeals.com. These are private mortgage investment, passive investments in my deals. So that's how you can participate in my deal flow. And number 3, finally, I am always buying houses that I can flip and occupied apartment buildings with below market rents. So if you have a deal that fits that description in either Atlanta, Chicago, or the Philadelphia region, please send me an email with the details. We are at the conclusion, my friend. Next up, we have Tim Padovic joining us to discuss how you can offer no money down financing to your retail fix and flip buyers while actually receiving all of your cash at closing. This is a valuable topic for fix and flip investors and real estate agents, and it works in all 50 states. Exciting stuff, right? Well, that's a wrap.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.